here. That's good. Hello, everybody. We're gonna mute this thing.
All right.
Mute this bad boy.
Are we going off of today's notes?
Yeah, take a look. I got notes. We got notes up there.
I'll just move my stuff over to today's notes then.
Yeah, just slap it in wherever. Load them on in, buddy. Up to you guys.
Well, I could go first. I'm going to talk about Robinhood's litigation.
Oh, yeah. I read about that in your other notes.
Mm-hmm.
Finally bringing a case.
Lastly, we can talk about UFOs. I'm going to go into some dark pool stuff.
Nice.
So that's going to be fun.
Life is better in the mountains, says Jeremy's shirt, but life is better in the metropolis, says his background. You got to paint some mountains behind the buildings, then you got the whole thing. All right. Let me know. Yeah,
what's going on, everybody? This is Random Rabbit podcast number 11. Whoa, there was a little stutter there. But we are happy to have you guys here. We're going on to our next week of news, next week of crypto, next week of federal rules, regulations, and just whatever ridiculous news we could come across. If you're joining us for the first time, I'm just kidding. Hey, welcome back. We know there's nobody new yet. So,
It's just the one new guy sitting there like, hey, wait a minute. What about me?
No, I'm pretty sure we had one viewer, and then he was just like, oh, snap, I think I just went into the wrong podcast.
Oh, snap.
There's somebody else doing a daily podcast.
And then he left, yeah.
It's because he realizes we don't talk about fluff.
That's right. There's only real content here. We don't have no fluff here. No filling.
No fluff, unless you're looking at our
There's no
bunny
fiddling
tails.
around here.
Our rabbit tails are pretty fluffy.
Yeah, the only fluff here is our tails, bro. Everything else is substance. Get with it.
Substance. Okay. Let's go down the rabbit hole. And
all right.
First set of news. Give me a second to pop this up. Okay.
I'll put the title in Google. I mean the YouTube thing.
Sounds good.
I'm logged in this way. I got it. Should probably put like current. I'm gonna remove my own comment so I can put topic. Message retracted. All right. So you ready to go?
Oh yeah, we're ready.
All right. Hi, everybody. So we're going to just kick it off here. So the first topic we're talking about is that the banks easily passed the 2021 stress test. So this is some stuff that's a kind of a mixture of today and some stuff that was at the end of last week. So the Fed announced the biggest 23 U.S. banks could withstand a severe recession, which because their capital is well above their minimum required capital levels. Of course it is. They have nothing but cash. They don't even know what to do with cash. They're telling people to stop giving them cash. They keep parking it in the Fed. The Fed gives them more cash. So they have more than enough money. But some of the parameters in the scenario of the global recession to give you an idea of what this stress test is they try to measure it against a real world recession and at some extreme levels to see how the banks would be able to maintain liquidity, because liquidity is really the main source of contractions in financial markets. You can have a deleveraging, you can have a big contraction, but you need to have liquidity to keep people happy and spending and people able to do their daily lives. So some of the things in this stress test are, it puts hits real estate and corporate debt holders. So the markets are getting hit both from real estate and the corporate debt holders, some of the biggest areas where we can see default and some damage. The peak unemployment is about 10.8%. There's a 55% drop in the stock market as a whole. So the entirety of the market sheds more than half of its value. And this would create a roughly $500 billion US hit to the industry. But the capital required was still twice as much as required minimum levels. So the bank says, all right, guys, you're good. You can do whatever you want. What does this mean? Dividends and buybacks. If you thought that your interest rates on your accounts were going to go up and you were going to make more money parking your money, no, that's completely wrong. You make 0.01% and everybody else makes more. They're going to use dividends and buybacks, and they're going to push these out over the next couple of months. And what's important to note about this is that there was a lot of pushback at the idea this would cause a free-for-all in higher dividends and stock buybacks to just kind of boost the value of the companies within the stock market. They just kind of like pump that value out to give back to their shareholders. But they kind of pushed back against that, saying that there are still other restrictions on the banks, and this won't amount to the same type of kind of belligerent spending, and they still have to maintain some requirements of capital. But as of today, JP Morgan doubled its dividend to 70 cents a share and announced a $12 billion stock buyback plan. They yet to hear the details for how long it's going to take or when it's going to start. But JP Morgan also boosted their dividends from 90 cents to $1 a share. So that activity is going up, but we've seen stock prices up 4, 6, 7% across the banking industry today. So definitely keep an eye out for that. If you're a stockholder that owns shares, of the banks, then you definitely got a windfall today. And may so for the rest of the week, depending on how these buybacks and stuff go out. Especially if you're a holder and you like dividends, well, then obviously higher dividends is going to make you happy as well. So
Cash in while you can, get those dividends, and then dip out.
right, you buy in before the ex-dividend date, which is the final date you're allowed to own a stock. But you have to own a stock when you're allowed to get a dividend. So if you buy and own before the ex-dividend date, then when that dividend is distributed afterwards, you will be eligible for it. If you buy after that, you won't get that dividend. But if you're holding before the next dividend date, then you'll get it then too. So that's the ticket. Get in before the ex-dividend date, and then you'll get a cut of that dividend per how many number of shares you own. Good stuff.
Sounds good. So for anybody who's wondering how to use this information, that's exactly how you use that information. You jump in, you jump out. Okay, topic number 2. The Fed is debating scaling back mortgage bond purchases. 2-speed tapper.
Yes, so let me just put that up here. So what's happening here is we already know, we've talked about, the Fed is planning on tapering off its big asset purchasing plans, which is basically like, hey, we'll buy assets from you, we'll give you liquidity for, with the cash in the market, you can do your everyday business and cover all your obligations, and it will cost you, we'll buy up debts and we'll buy up assets that you may be holding. So we kind of trade it there. The Fed has bought effectively $982 billion of the mortgage bonds since March 5th, 2020, when they started buying to help provide liquidity to that market, to keep housing from going under, right, to keep all the rates really low, because as they continue to buy $40 billion each month after that, they continue to buy. What's happening is you're keeping the cost of borrowing much lower, so you're keeping people from having these high mortgage rates because you're buying up all the debt. So the risk is much lower because the government will literally buy the debt out of the market. And the thing about this is that it does help push down these rates, and some of the Fed officials have come out and said this has some unintended consequences. Because if you look at a peak of demand, you look at a contraction of supply, then you also say, well, then mortgage rates are so low because they're buying up all the debt. You add to the fuel of this, this kind of housing boom fire where the prices are up 24 to 30% across the board for most new houses, and people are getting outbid every time they try to buy a house. So it's really that the Fed stopped backstopping this market already, because it's booming. Right? The mortgage home market, the housing market doesn't need help. Like it's actually growing and booming in value. It doesn't need just fine on its own. It does not need the extra help of keeping these rates lower. And other Fed officials on the other side, right, they're arguing that the combined purchase of mortgage and treasury securities are keeping the entirety of long-term borrowing rates down overall, which is true, right? Which is why they did this across the board, because you find the place where you're going to have the biggest rates, you find the place where you're going to have the most demand, and you buy all that debt. So therefore, you keep the rates low and you keep liquidity in those high demand markets. The only problem is, we're seeing a different reality now. We're no longer in the middle of COVID. We're in the aftermath where these markets are burning up really, really hot. So it doesn't really justify the need to do this. So they're suggesting a 2-speed taper where they taper off mortgage buying first, and then they taper off the treasuries as well. So they don't do everything at once. They try to do it one and then the other. The only issue with this is that it does create a bit of the reason they might not want to do this is because it does create complexity in when they try to push this out into the market and people know what is being sold and when, and that's where we get these taper tantrums, right? We don't want to make it too complicated, because financial markets might not know how to deal with that. They may react erroneously. So that's the debate. Should we start doing that early, or is 2-speed too complicated to implement it at this time? So, but the whole thing is that we're having artificial rate hold downs as a result of this. But do we really need it? And is it really helping the housing market that is exploding in value with some of the lowest mortgage rates we've seen in quite a long time? So I would say that they definitely should stop doing this. I think they should stop doing all of it. But the most effective way to do this, the most effective way to raise mortgage rates and cool that market is to raise those rates. And to do that, you have to just raise interest rates, period. So the Fed said they're not going to do that until 2023. So even if they do stop buying back mortgage bonds, it might not have as big of an impact as raising interest rates would in general. So I think that, and I, again, proponent that I think they should move a little bit faster in this respect. But I definitely think this is a good idea because the mortgage market and the housing market is burning pretty hot. So I don't think it needs any more help. I don't think it does.
Good insight. Yeah. We're going to continue seeing more and more of how this is going to affect the potential housing crisis. And I mean, do you predict this accelerating it or potentially even fixing it?
I think this is just part of why it is so red hot. I think the biggest drivers are demand and a lack of supply. And demand being the biggest one to push the prices. Because remember, even if there's a lack of supply, if there's not so much demand, then the prices don't go up. It really has a balance here. But we're seeing a lot of demand that is fulfilled both by supply or the ability to buy things. And I think that demand is the hardest part of this to manage. And if you're trying to manage demand, you have to raise finance mortgage rates, because if it's more expensive to get a mortgage, you're less likely to buy a house. So it would cool the demand of people trying to get homes. But to do that, the most effective way is to do it straightforward, to raise interest rates. So I think that's all kind of baked in, and I think that's what they're kind of noticing, because they've been doing this since March, and these prices have been elevated now for months. So I think it's already kind of baked into it, but I think the longer it goes on, the worse it's going to get, just in terms of keeping that market, so expensive for much longer. So
sounds good. Okay. It looks like Windows 11 is coming out. Tell us a little bit more about that.
Microsoft has announced Windows 11 last week. I believe it was on Friday, and it took some shots at Apple specifically. So the CEO of Microsoft currently, he says that we need a world full of more open platforms, and is taking shots directly at Apple's kind of closed walled garden approach, and they're very they force them to pay 30% of all sale in the App Store, regardless of who you are, as well as if you buy in-app purchases. So they're trying to enforce it. They're basically saying, you have our products, you're in our network, and you follow these rules. And the arguments are it keeps people secure and it keeps people safe, but other people argue that it's limiting and anti-competitive. But for the new Windows OS, it's the first one to come out after 6 years, and Microsoft hit a market cap of $2 trillion for the first time as a result after its day's reveal. And some of the interesting features that I think would be interesting is that they have a new app store that collaborates with Amazon. And on top of that, the new Windows 11 will be able to run Android apps on your PC from the Amazon store. So you'll actually be able to run them on your local PC, which is pretty cool. And they also are using a lot more of the the Microsoft Teams software, which is really designed for collaborative working. Became very popular over the coronavirus. It went from 20 million daily active users to 145, which is something that seems like it makes sense, but it makes sense why they would double down on this and put more features into their new operating system to kind of support that. They have a universal mute button. I think is pretty cool. And Microsoft, this is the shot that's at Apple, right? Microsoft says it won't require developers to use its payment system. So you're allowed to use your own payment system, where they will take no fees. And if you decide to use their payment system, they'll only take about 15% and 12% if you're a game developer. If you're selling games on Xbox, they will still be taking 30%, but this is specifically for the Windows OS. So you can use your own and not pay anything. And even if you use theirs, you're going to have at least half of what Apple is taking. So that's a direct shot at Apple. Attempts to just show people like this is a different marketplace for you to sell your applications, that we're not going to take as much, and we won't even take anything if you want to use your own systems. So much different from Apple, where it's like no matter what you use, you'll be paying us 30%, even if your app has in-app purchases. To like for Epic Games and Fortnite, if they buy something there, we get 30% of in-app purchases as well. So definitely a very interesting shot there. And the idea here is that they want to make a platform for platform creators. So they want to let people kind of expand their ideas beyond just the applications. They want to help them to grow in an open source space, as opposed to something that's much more closed down. And the other thing is that this is kind of reigniting a fight between Microsoft and Apple. We used to see those commercials. I'm a PC, I'm a Mac kind of thing. I don't know if anybody remembers that from back in the day. But then things kind of got quiet for a while. But now it's kind of reigniting that fight because they're fighting for more market share. And right now, Apple, during the Epic Games trial, right, they were saying, hey, Epic Games is saying that we shouldn't be allowed to charge 30%, but Microsoft backed Epic Games. So in that trial, Apple was saying that Microsoft might be a puppet master, just using Epic Games to take shots at Apple. Using them as an example, but I don't know if there's any weight to that, but that's definitely what Apple will use to defend itself. We'll get the ruling on that case, I think, in a couple weeks. They're still deliberating on that and seeing how that works out. So we'll definitely let you know how it turns out with Epic Games and if Apple wins that or not. But the Microsoft and Apple have been really friends and enemies at the same time, right? They're in the same market. Bill Gates and Apple, they kind of Steve Jobs, they kind of went their own certain ways after building their initial computers, and then they kind of built their company separately in two really separate directions. One for more functionality, one for more like the way it looked, the felt, and all the connecting of everything. So I think it'll definitely be interesting, and definitely something to pay attention to, because we could see a lot of really interesting technology come out of Microsoft and Apple as they're now competing and kind of taking shots at each other as they try to develop and see who can own more of this space, who can bring more developers onto their platform. And also, just as a side note, that Apple is also currently facing an antitrust probe in the UK over its app pricing, its app store rules and its pricing strategy. So the UK tries comes after everybody for antitrust for the tech companies. Google's paying out big. I think Facebook's paying out big in some of those cases too. So,
well, hopefully we'll be able to get rid of so many Apple adapters if this continues this trend with Microsoft.
Right. What do you mean? Like the dongles?
Well, just domino effect. Just what they're trying to do, developers right now. Microsoft might just be like, yeah, we're gonna just not do with the extra adapters that are $50+ for some little thing for
Right.
like Apple, but
Right.
that's just part of their business scheme.
I mean, cross
Apple
platforms, everything right now. Like if you're
right,
not,
but I think the thing is, like device compatibility. Like Apple's the kind of company that says we'll take off the headphone jack and then we'll sell you wireless headphones separately, but you don't have a headphone jack on your phone. I'm like, really?
Yeah, that's like the worst thing.
They sold their new like desktop monitor for like $4,000, but the stand for it they sell separately for $1,000. So it's like, you want to actually have your monitor on your desk, you're gonna pay $1,000 for the specially made stand. And I'm like, really?
Sure.
That's
That's
really what you're gonna
do?
do?
A bunch of people just have it leaned up against their wall.
Why not? At that point, I was like, yeah, well, this looks like crap. Well, I'm not paying $1,000 for a metal stand that should come with the computer. I don't. Everybody else does it, so I have no love for Apple though. So I got no love for Apple. Its pricing, its style, its compatibility. No love.
No love here. Okay. Next topic.
All right, so next topic here is a big one, interesting for today specifically. U.S. District Judge James Boasberg from Washington said the FTC's lawsuit was legally insufficient because it did not plead enough allegations to support monopolizing claims against Facebook. So remember we were talking about Facebook having, as one of the big companies in big tech, that was targeted for antitrust and monopolization. Well, there was a big blow to all those cases today, and Facebook finished above $1 trillion market cap today because of this, because they were like, you don't have enough evidence, or you didn't prove what you said you were going to prove, or it's not substantial enough. So let's kind of go through this for a second, break it down. So they said the FTC's lawsuit was legally insufficient because it did not plead enough allegations to support monopolizing claims against Facebook. This is interesting because they're correct. When you define a monopoly, it is something that takes an undue amount of pricing control and that adversely affects consumers. So if a company basically corners a market and says, I'm the only person you can buy a car from, I can charge you any price I want because where else are you going to go to get a car? That would be a monopoly, right? Because you are cornering the market and making people, hurting consumers by your pricing scheme. We have multiple companies, they have to compete against each other, so prices are always kept in some kind of floating fair market price, because if there's 3 people that can sell you cars, if you don't like that one, you'll go to the next one. Everyone will keep trying to find a price level that's most acceptable. But the problem is that our laws aren't built for the kinds of size, power, and influence that tech companies have. There is no harm, and they argue this successfully. There is no harm to consumers. We don't pay for any of these services. How can it be hurting the consumer? You're right. But it's not a question of hurting the consumer. It's a question of the actual ownership of data. It's the question of influence and control. The fact that One of the things the FTC alleged was that that Facebook had engaged in unlawful monopolization by buying up its competitors such as Instagram and WhatsApp instead of competing with them, and would want them to unwind or divest those investments back into individual companies. The problem is when you don't pay for any of these services, how are you going to measure actually hurting consumers? You're not. So our laws in this case, in terms of size and influence, are not written for this type of company. So to apply them will be very, very difficult because there is no harm to me. I can have Facebook, Instagram, WhatsApp. They're all free. They don't cost me anything. So it doesn't actually hurt me for Facebook to own all of it. But they are becoming a conglomerate of companies and controlling most of the technology. And you can see things like this in the Cambridge Analyticas, or who's selling my data and where is it being used and how's it being sourced. And they make most of their money on revenue and tracking. And the argument is now, you should make your data personalized. It should be a personal asset that we have the right to own, and we have the right to say what people can and cannot do with it. But again, our laws aren't structured that way. So it's going to be very interesting going forward how this is going to work. And the judge also dismissed the states. About 46 states came up with a case. They dismissed it out entirely, saying on the ground that they had waited too long to bring their claims. And the states had argued that Facebook degraded personal privacy and exploited consumer data because it had no rivals to keep it in check. So that was just a legality thing. They said, hey, you didn't bring these up in time, so we're going to dismiss the case. So there's a lot of work to do on this front, but it's a big blow against the first big news to come out since we discussed that the government and states and everybody were considering these antitrust suits. So it just definitely is a big point to note that our laws weren't structured this way. So there's going to have to be a change to the language of the laws or a set of new laws, and specifically to actually, I think, make this stick and make this effective. So I think that's really the kind of the gist for this. All right, hit $1 trillion U.S. market cap, and remember, this is also interesting that the company Facebook suffered 19% loss in 2018 when it came out about Cambridge Analytica helping Brexit occur, helping Ted Cruz become president, helping Donald Trump become president, because they were basically meant for hire. And there's a couple of good documentaries on Netflix. One's the Great Hack. It's from 2019. It's about Cambridge Analytica, and The Social Dilemma, which is about the current social media. Some of the biggest developers that were in the rooms and helping to build all this stuff, discussing the problems and the actual effects of this stuff, and what the AIs that run social media, right? Because most of the things you see are actually run by AI. Most of the things that run your updates and processing and load your customized pages and do all that stuff, track the content you want, show you what you want to see, are all AIs dictating these things and trying to reach goals, as opposed to thinking about what's good and what's best. That's, for instance, you getting a whole page of information that's only things you want to see, not contrary opinions. So these are all kind of compounding, and I think over time we're going to see more law come and write more specific language for the kind of power and influence that's happening here and the danger that's here. But I don't think our current laws will work it. So I think it makes sense that these monopoly laws didn't really work here, and that the lawsuits took a big blow, because their wording and their what they're alleging doesn't actually match up to what they're trying to actually do to these companies. So definitely, Facebook was up big today. So up over $1 trillion, and we'll have more news for this to come. We'll be watching this and see how this kind of develops. I know they're not going to stop coming after these companies, so we're going to see how they change their approach to see what happens next.
I mean, with Facebook being such a big powerhouse, to not say that they haven't monopolized a part of the market is kind of naive.
But it's by definition, because that's what I'm saying. The law says when you're a monopoly, how do you define a monopoly? Just being big isn't a monopoly. A monopoly has to cause harm, because if you truly monopolize the market, you control the pricing of an asset. If you control the pricing of an asset, you can basically make people pay whatever you want them to pay, because there really is no competition. Facebook doesn't cost anything. It's free because we're the service. If something is free, it's because you're the service. Every time you say, I use Google for free and I use Facebook for free, that's because they're taking all of your data. Cambridge Analytica that had 5,000 data points on you, they all got that from Facebook data. They extracted it all right from Facebook. So it's your data is what's most valuable. That's why it doesn't cost anything. But that's why you're not really a monopoly, because you can't prove that if Facebook and Amazon, everybody came together, but it didn't raise prices for consumers and the consumers were happy and not being harmed, you can't argue the current monopoly laws, because by definition, they're not hurting anybody.
Yeah, the ones who got sued for doing monopolistic tendencies was Walmart. They were always being looked after because of that. They're always putting the prices lower because they wanted to be competitive in the market and take out all the mom and pop shops. But yeah,
Right.
Facebook
that was
is
different 'cause
definitely just huge.
Right, and that was specific to Walmart because they were hurting people. Right? They were putting people out of business and forcing people into a corner. You know, most people would argue that Facebook buying Instagram and WhatsApp made it more convenient for them because now all of a sudden everything's under one roof. But yeah, it's free and you don't have to pay for it. But there's other damage and influence and dangers that come in here that our current laws don't actually address. So I think we need to rework the language of those things before they can truly have the impact we want them to have. But I definitely agree. We should be bringing up. I'm not a big fan of big tech, and I'm not a big fan of how much power and control they have going forward. I think we should kind of rein that in a little.
Definitely. I mean, I know when you're over in like Silicon Valley, that the whole Stanford area, everybody knows. Well, obviously everybody knows Facebook, but their buildings are all like they're everywhere, and not only just their buildings. But one thing that I learned while I was down there several years ago was how much housing space they're purchasing, and just how much like they're pretty much providing rentals at a low cost for a certain period of time until they then will most likely jack up the price into that same housing cost that it would be to live around there, which is pretty ridiculous. And so, if you think they're just a social media company, that's incorrect. If you think they're just a housing company, that's incorrect as well. I believe they're sticking their hands in a lot of things and potentially taking over the valley.
The other thing to note about tech companies, because I was at Menlo Park like earlier this year, Jared, right? It was like in January we were there.
Yeah.
And the thing is, like I was walking around the block one morning, and some of the like front yards, like you think you're going to Silicon Valley and like there's all these beautiful houses and everything. Menlo Park, these are all just communities that apparently I was like a couple miles away from the murder capital of California for like a decade of time, and I'm like, well, why is Silicon Valley here? Why is everything so expensive? I realized when they moved there, the value of the land increased. So these communities were just everyday communities that all of a sudden now their homes are worth twice as much because Silicon Valley's there, which sounds great, except for the fact that you have a progressive tax system. So now all of a sudden they're paying twice, 3 times as much in taxes every single year. So families were leaving all the time because they're basically like, I can't afford to live here anymore. So I have to sell what I can and leave. So just because a company moves in doesn't mean it's great for everybody, right? If a community already exists there and all of a sudden the prices go up dramatically, next thing you know, people are strapped for cash because they didn't choose for that to happen there. They probably didn't even get a vote. It's amazing how many things happen to people's communities and lives when you don't really get a say in it. Some company's going to buy up all this land and plant themselves there, and your houses are going to go up twice in value. Do I get a vote on that? No. I guess I'll just deal with that. Completely.
Yeah, and the thing is that we were walking around and we saw that there's a huge Facebook campus there, but no one was there. It wasn't in use. They're just buying up property, making these new campuses, probably adding them to their balance sheet to say they're expanding, but no one's using them.
They're just huge, giant buildings everywhere, and they're just like empty, dead. Just like this is what's happening. All these people losing their homes and got to move because you just want to buy up square miles of land.
Yeah, and the majority of their workers, they could all work from home. They're all programmers.
Exactly.
So why are they making these campuses and everything? So, like,
especially after the coronavirus,
all these people got, went through eminent domain where they had to get pushed out of their homes, and there is now a campus that's just not in use. And one side of the freeway's nice, beautiful houses. The other side of the freeway was very close, kind of houses.
Yeah, and I think it's gonna be interesting to see now that companies are like everyone can work from home, and now the coronavirus did all this and kind of disrupted all the markets and says, oh, everyone can work from home for technology. What are these companies going to do with all these campuses? Are they going to keep them staffed at 25%? Because I think the original reason everybody wanted everyone to come back into work is, yes, there's a theory that there's more motivation in being in the office, and I agree there is some truth to psychology there. But I also think that it's because, hey, we just bought all these really big buildings and we have to pay to keep the lights on. So if you're not here working, then what are we paying for? Get your ass back in the office so that when I pay that power bill, I'm paying for production. I'm not just wasting it. That I'm like, what are you going to do with all that space now? All these huge campuses, they're 50 capacity. They're just going to continue to suck up power and energy and sit there? I don't know.
Yeah, it's definitely an interesting dilemma because I know I was talking with my dad, and he's a director of finance, something like that, and he was saying that productivity didn't actually go down, that everybody was completely okay with continuing work at home, knowing that everything was getting done. If anything, things were kind of getting done faster. And so it kind of comes to a question of, is it better to have people at work or, in the comfort of their own home. Now, there are those people who want to come to work. They're only productive at work. By all means, understand how you function. But for if the argument is productivity, I don't think that's a factor anymore. I think it comes down to, who's occupying the building and potentially maybe for a tax write-off. I'm not exactly sure how this works, but there has to be a certain percent of the building occupied, and most likely occupied with your own workers. Who knows?
Right.
And so that kind of makes sense.
Commercial real estate really took a hit. Commercial real estate has been taking a hit. And to all the husbands that want to get away from their wives, I'm sorry that the pandemic hurt you so much, but it made you get your work done that much faster to get out of the house.
You're welcome.
I'm so much more productive when I gotta escape. Gotta get outside.
The kids are driving me crazy. I couldn't do it.
Doubled your productivity. I spent half as much time with my wife.
Okay.
So, interesting. It'll be interesting to see how these next couple of years, what these tech companies do all these assets. Sure.
So, we're going to take a quick little break. When we come back, Jeremy's going to be sharing with us some Robinhood information, Russell 1000 ETF, dark pools, and kind of what they mean in order to, navigate through and understand how the stock market's working. So, we'll be right back. Thanks for joining us.
All right, so we're going to be going into Robinhood's litigation by Roseland Legal. So we all know what happened in January, where the run of GameStop went up to around $420+, and then all of a sudden went down. And Robinhood was a huge factor in that because they stopped trading. They stopped trading, and not stopped trading. They just made it so that people could not buy GME anymore. And because of that, they believe that people ended up just selling off their positions. We all know what happened. It went down to $40 within the next day or two. So this is the litigation that is being held up by Rosen Legal. And the most interesting part about it is that they show on page 7 the short interest on January 15th. Now, people believe that on the FINRA site that the short interest was just a blimp, that it wasn't 226.42%, and it was a short interest. Well, guess what? It wasn't just a blimp. It wasn't just a glitch. This is actually the short interest that was there on January 15th, 2021, with GameStop at a short interest of 226%. 226%, guys. How does it go from 226% and the next day they say it's at 20%? Yet the price didn't go up from there. It just went straight down.
Nice.
You know, that's
Fraud and lies.
Fraud and lies, smoke and mirrors. So this is why. This is even more proof to show that this is a really, really highly manipulative and fraudulent game that they are playing, and they are now getting caught. So it's huge. If you want to opt into this lawsuit, just go to Rosen Legal. If you lost any money, and you can opt into this lawsuit. And
make sure you only opt in if you had losses. Don't just opt in because you wanted.
Yeah,
like,
you make sure you own GME at the time, and you're able to prove it.
And what time period is that? So I believe we're going to have several viewers who do own GME and have owned it for, the last couple years. How long do you have had to have owned this in order to, take part of this?
Well, you just had to have owned GameStop during the time Robinhood shut off tradings, and if that affected you in any which way, you are able to hop into this class action lawsuit and ride the wave of suing the pants off of Robinhood. So that's going to be really exciting.
If you just want to Robinhood squirm, this is the best legal payback you're gonna get. Just take the money right out of their pockets.
Take their money, get it all, and when I was a little boy in Bulgaria, he can go back to Bulgaria if you'd like afterwards, because everyone's gonna know his face.
Wait, what?
Yep.
You're the CEO? I don't know what that just came out of nowhere. If you're a little boy from Bulgaria, you're going back.
What?
That's the CEO of Robinhood. He's from
Bulgaria.
He's from Bulgaria, and during the time he was getting interrogated for everything by Congress, and we would always start out with, well, when I was a little boy in Bulgaria, and
I was
just
a
right
wee
there,
boy. Like, no one cares. We're talking about today. Like, we move this along.
2.5-3 minutes. He would start out by taking 30 seconds of the time to just say, when I was in Bulgaria, and then there you go, and then they're like, answer the question. Well,
guess what? You're not in Bulgaria right now. You're in the United States Congress answering questions. So move us the fuck along, please.
You're a grown man.
Yeah, no one cares about what you were. Yeah, you were born. You were so cute. That's great. Right now, you're guilty of fraud. So can we just move this fucking along a little bit?
Well, we need to welcome GME into the Russell 1000.
Woo. Welcome, GME.
Yep, the Russell 1000 just bought up 42,455 shares for a weight in the Russell 1000 of 0.03%. So we all know XRT is overly shorted, and I saw it today at 222% shorted again, down from 204%. But what happens now is they're not going to try shorting the Russell 1000. It's too top heavy. They have Facebook, Google, Amazon. They got these big guys in there. So if they're going to try shorting it, it's going to take a huge chunk of change. But let's talk about the most important thing right now, dark pools. So what are dark pools? Well, dark pools are private asset exchanges designed to provide additional liquidity and anonymity for trading large blocks of securities away from the public eye. So what does that mean? That means if I'm JP Morgan and I have to put a buy order for $500 million for Apple shares, I don't want to put that on the market. I want to be able to do, and by the way, you're able to do iceberg trades on your regularly trading for retail traders. But for them,
what's an iceberg trade?
Well, iceberg trades are where you're able to just put like, hey, I want to buy 1,000 shares. I'm just going to show that I'm going to buy up only 100 shares. I'm only going to show like a tiny fraction of my order.
Icebergs are small above the surface and deep below.
There we go. Right. That makes sense.
So we can do iceberg orders if we wanted, but for them, they're like, well, we have millions of dollars and we don't want to just do iceberg trading strategies. No, we want to have our own exchange off-market exchange. So for us, our orders go through our brokers. It then goes through the DTCC, which is the trading, which is a clearinghouse, and we can see all the orders on our level 2 when we're doing trades. Now for them, for the wonderful market makers like JP Morgan, Goldman Sachs, Citadel, all these big guys, they use an alternative way to get their trades in, and that is called dark pools. So if we see the CBOE gives us this chart of the percentage of what these exchanges and how much of the order flow goes through these exchanges. So if we see that very top line is the NASD ADF, and the ADF stands for Alternative Display Facility. Now we can see right there that the majority of trades are going through these dark pools. They're going through the market makers, just putting, taking advantage of these dark pools, and they don't even have to put it on the exchange, and we don't even know. Well, I mean, if you've ever seen a level 2 while you're trading, you'll out of nowhere you'll just see a blank exchange come in with 1,000 buy orders or 10,000 sell orders, and you just see the stock jump or drop just in a moment's notice, and those are dark pools. You don't see them coming. It just happens. They don't have to show you that they're even on the market for their order. It just happens. Meanwhile, the retail investor needs to put their orders on the market, and they see that, and they're able to use these high frequency trading bots in order to get the best price and tick down and chip away off your profits. But the most egregious thing that they can do is not report their trades. People are saying, oh, they need to report their trades. Well, guess what? If you go to FINRA.org and you go to the filing report, market transparency report, and then the trading report facts, you can then see that there is a question 102.2 that says, does the 10-second reporting requirement apply to the submission of non-tape reports to FINRA? That just means, do dark pools have to report their trades to FINRA? No, they don't. Members are not required to submit non-tape reports to FINRA within 10 seconds of trade execution. However, regulatory reports generally are required to be submitted within specified timeframes. That means they get leeway. They get to be like, hey, we shorted a stock. We don't even have to report it to you. We naked shorted it. We don't even have to report it. They can hide whatever they want on these dark pools, and FINRA allowed it. FINRA, by the way, stands for Financial Industry Regulatory Authority, and AKA they do what they want, and if you have money, they allow you to do what you want. So
welcome to the flip side of capitalism. You got enough money, you can make your own set of rules, and then most people don't look for those rules, and everyone's like, why isn't it fair? They, well, it's not fair because you don't work hard enough and you didn't put enough money, and you should get smart. It's like, yeah, also there's a whole different set of rules for them that they can play that we can't do it. So maybe FINRA should stop running its mouth and actually do its job, since it's a regulatory body, not a fucking giveaway.
Exactly. It's unfair. They're able to hide their naked shorting or anything they want because they can, and FINRA allows it. And we need to make this a more even playing field. I'm not saying get rid of dark pools, but I'm saying get rid of dark pools. It's if you have over 40% of trading going on through dark pools in which they're hypothesizing that these shorts are able to just trade with their shorts and back and forth, so it's like hot potato on their positions so that they never get caught. When the SEC comes over and they say, hey, what is happening, with their little spotlight, and they're all like, oh no, it's not me. I don't have these these positions. What are you talking about? Feign ignorance. That's the best way to put it. So dark pools, though they sound cool, they really have been messing with the market, and these the regulators have even come forward to say as much, and say that there's not the proper price valuation is due to this as well.
Because then they would have to actually spend their time doing real work and actually regulating and making sure things are fair, not just kind of sitting there and meeting occasionally and be like, yeah, everything's okay. If you're going to be a regulator, and you're going to be a regulatory body, your role is bigger than yourselves. Your careers don't matter. Your job is to make the markets fair. And I think that over the last 20, 30, 40, 50 years, our regulatory bodies have really, to put it slightly, shit the bed when doing their jobs. And they need to do better, because these functions exist for reasons that actually make sense and are valid. But then the human beings that allow them to be misused and continue to allow them to be misused and don't give a damn that they're being misused, they need to be held accountable. All of these regulatory bodies, these people need to be investigated, and they need to be tried and said, do you actually know what you're doing? Are you actually looking at these things? What are you actually going to do to make? And if not, we need some people that are actually willing to step up and say, I'm prepared to do the work and slog it out. Like all the lobbyists and all the ridiculous amount of money being pumped into legislation from all these companies, I'm willing to actually do my job and say, that's not going to work anymore. I want to make changes that make the markets fair for everybody, because in the end, they're not, and the markets just become a wild free-for-all for only the wealthiest. You're going to lose a lot of investment in the markets, and they're no longer going to do what they were supposed to do. It's just going to be a betting ground for the very wealthy, and that's not what it was built for, and that's not what it should become. So if I think if regulatory bodies want to protect the markets from collapse, as well as protect themselves from being invalidated by future legislation, they should start doing their jobs. Because I bet you have younger individuals in Congress and the Senate, younger individuals in the White House. Once these older generations have kind of moved on, I think that then they're going to be subject to serious repercussions. So they should just get out ahead of it and do their jobs. Please just do your job. I don't understand how hard
that's all they have to do.
Do your job.
Do their job. And the SEC's right there like, well, we don't see fraud. It's because you allowed them to get away with fraud, so that there's just like, hey, you don't even have to report something. I could look the other way. And now it's catching up to them.
They sit there and they're like, well, we wrote these laws, so they're following these laws. I'm like, because the laws are garbage. You're going to tell me we wrote these laws, so this is good enough? You obviously need to do a thorough assessment of, they're complicated, it's a lot of work. It's because you wrote complex laws that make it impossible for things to be changed. You now need to go back and undo that and actually make the laws make sense, because you're right. It does, based on these laws, they're allowed to do that. But these laws are not effective, and they're not fair, and they're not what they're supposed to be in the market. Okay, so you need to reevaluate the laws, which means, you're going to have to do some work. You're going to have to actually do some work.
Yeah. And next we're going to go into this really cool site. It's called StockGrid. So StockGrid, if you go on there, stockgrid.io, it's all about the dark pools. When you first get on it, it's going to say QQQ. You could just click that and then press
I got
GME
Bria Cell. I got BCTX, Bria Cell Therapeutics.
Just click that. Click GME, and you can see the amount of what's happening with the total volumes and the short volume, and this is great. This is great data to see what's happening in the market through dark pools as well, with whatever data FINRA is giving us. That is not every. I bet there's still much more that's happening behind in the background. We're not able to get 100% of the data, I bet, but this is definitely a really good step, and it's really cool. You can see when you look down, you can see the net short volume, and it's just a lot of stuff. We could go back to the other site as well, and you can see during the times at which you believe a lot of things happened with the market tanking, like GME, and you can see a lot more has happened percentage-wise in dark pools. So this is just a really cool site, stockgrid.io/dark pools, and you could do your research into the short volume percentage, everything like that, and check out for yourself, see what's happening.
Definitely a good resource.
Really good resource. So aside from that, anyone have any questions, if there are any viewers?
All right, so I just popped up GMEs, and from what we were previously looking at, looked like a normal chart, and here we can totally see the drastic change between I mean, just the activity in dark pools before it looked like this, and now we're getting these, empty high rises.
Yeah, look at that. The total volume from FINRA, 97,000. Short volume, 33,000. This was on January 1st, 22nd. And you can see that's the highest spike where the short volume was the highest. That's 1/3 of all trading volume occurring right there was short volume. And if you go down, you can see the net short volume as it spiked down on January 26, 2021. It spiked down all the way down where the volume went really low. Net money volume, net cash volume. So these are all really cool charts. Do your due diligence and check it out. But as of this moment, I think it's definitive to say that GME's short volume they never covered their shorts, and the short volume is short interest is still up there. And with everything that has been occurring, I don't doubt that it's over 400% at this moment that GME is shorted. So, do with what you want with that information. But
what are you doing with that information?
Well, this is not financial advice, but I sure am in GME, and everything is showing that it's going to keep rising. If you see the chart now in GME, you will see that every 21 days, when it's failed to delivery time, the floor keeps rising. So right now it is at 200 floor. In 21 days, it's going to be higher, and 21 days from now, it's going to be higher. And that's just a pattern that you just keep seeing in GME right now. And they're running out of money. They're trying to cover up their positions with all these deep in the money options in order to hide their shares, their shorts. And, it's only going to last so long.
So who's running out of money? GME's running out of money?
Citadel is running out of money. These large institutions are running out of money. Malvern Capital never closed all their positions. I love the news article that said Malvern Capital says they closed all their public positions. And I'm just like, I love it because it said public positions. Right. And I'm just like, of course they're not going to show that it's all their positions, but I believe Malvern Capital is going to be the first hedge fund to default, just after, of course, this prior one in London defaulted. What is it?
White Square.
White Square. Yep. Yeah. They're the first ones, but that was because of their investors. I believe Malvern Capital is going to be the first one to default because they didn't want Malvern Capital to default. You know why? You know what gives me more proof? Point72 and Citadel invested $2.4 billion more into Malvern Capital after that whole incident. So you think they want Malvern to default? No, because they are holding a very, very large position in shorts as well. So.
Okay.
Very nice.
This is just still growing and growing, and it's actually making sense to me. So I feel like if you guys are watching this, it should be making sense to you guys as well. There's some pretty trickery going on with GME and its investors and large institutions and the way they've been playing with the money. And so far, I believe GME is going to take advantage of this. GameStop's going to probably come out of the grave and pop out with some, latest technology, hopefully change their business model and strive from this. So if you're holding on to GME, keep those diamond hands, baby. Keep those diamond hands. Okay. Let's go on to the next topic, which is going to be cryptocurrency. And so if you've been following the market, you know that it's been one heck of a roller coaster from, at least the last year. And so we're just going to continue following. So right now we're looking at different countries who are either going to be putting their foot down into cryptocurrency or they're going to be trying to adopt cryptocurrency. Now we're going to first jump into who's going to be cracking down. And this is the latest news. The UK puts pretty much starts warning their citizens, hey, this is a very risky investment. This isn't an asset that they have any type of ownership in. And so for them, this is going to be where they're kind of pulling back. There are no rules, there's no regulations that the UK is able to implement, and therefore I believe they're going to be progressing towards a cryptocurrency of their own and or adopting some that I'm not sure how many cryptocurrencies are being established or built into UK, but why?
They'll make it CBDC. What'll happen is that we see with China, United States, many of the countries in Europe, is they make something called a CBDC, which is a central bank digital coin. And what it means is they use the blockchain technology, which I'm a fan of, but they don't just pick up a free floating coin that they have no control over. They basically allow the Federal Reserve to be a direct money supplier and be kind of like basically a central bank of its own to be to allow to the distribution and creation of that coin using the same technology, the blockchain, to allow more accessibility. But the other flip side to that, and that's important, is that when you do that, you allow a government to play a bigger role in finance, meaning they bypass banks.
Less
This is the other thing you have
decentralized.
Right. Well, not even less. Yeah. So basically less
bypass
decentralized.
banks. That sounds bigger.
Bypassing banks, what that means is if the federal government can create currency. Okay, there's a reason we have central banks and we have things separated, right? The Federal Reserve, the central banks, the central government. One can create money, one can create laws, one can sell money, can create money and put liquidity into the market by buying assets from the central banks. And it is important that there's a separation of these first, because no one can just make and give money at the same time. It's not like an unlimited water fountain. When the government's able to create their coins, then you do business directly with the government. You don't need banks. You can just buy and sell and store and retrieve directly from the central government, which is a big government policy, which is something that I am also a little bit opposed to. There are some things I think the government should regulate, but I don't think that we should get rid of banks, because it does create competition. It does create the ability to get lower rates. It does give more liquidity in the market as a whole, and it doesn't depend on solely your government to control all of your currency directly. So that is an argument against the CBDCs, but I think in the end, that's the only way the digital currency is going to exist in most countries, is because governments need to control them so they can control them for financial and economic measurements, but then they have more control over them.
Oh, that's very interesting. Okay, so we'll definitely keep looking at UK to see what type of cryptocurrency they're going to come out with, but whenever there's a country that comes out saying that they're putting their foot down or they're supporting it, the fluctuation of Bitcoin takes a hit. And with a big country like UK, it being a world power and all, I imagine that Bitcoin was going to take a big hit. That was not the case. And so Bitcoin shrugs off UK crackdown on major crypto exchange Binance. Now, this Binance is just one of a few exchanges, but it is a pretty large one with, I believe, one of the greatest number of user growths over the last year. And yeah,
there's an article that I'm reading from MarketWatch. Says one of the largest owners of Bitcoin, who reportedly held as much as $1 billion of it, died at the age of 41.
Oh snap!
So I wonder what happens to that $1 billion of Bitcoin.
That sounds like the government might acquire it. That'll definitely be something we could search more into, because the transfer of how Bitcoin or other cryptocurrencies get transferred over all depends on how it's defined, correct? According to whether it's defined as an asset, a legal tender,
Here's the problem. If you die and no one knows your seed phrase, it's in a wallet, right? How the hell do you get to it?
Oh yeah.
That $1 billion could decrease from existence. It's like, well, there's money, and then to get in, they would say, well, we hacked into the Bitcoin wallet. Well, whose job is that? And if they do, I want to know who they are, because that's a big red flag. Because if they're like, yeah, listen, he died, but we wanted to give it away, so we hacked into it and got it back, that's when I'm gonna be like, hold on, they did what now?
Well,
I don't know.
I imagine that anybody who has $1 billion worth of crypto is also using, financial advisors who potentially have access to his accounts, right?
I don't know. We'd have to.
I mean, hopefully. Yeah.
And so from one country, let's go to another country. as people are putting their foot down, people are opening their doors. Now, big news is that Mexico, and this was everywhere, Mexico was saying that they want to create their first bank that accepts crypto. And this is being backed by one of their billionaires, Ricardo Plago. I probably totally butchered that name. And I believe he's a chair. He's a chair on the bank, or in the parent bank of them. And he's already a strong supporter of cryptocurrency. He's been saying that majority of your wealth, if you want to be able to keep it over the long term, you're going to want to transfer it over into Bitcoin. Now, unfortunately, the Bank of Mexico does not agree with him. They immediately said, no, we're not going to do this. It's first not considered a legal tender. That's one big step that the country itself would have to take in order to adopt it into the bank. And furthermore, if you watch one of our podcasts where we argued what it would take for banks to adopt Bitcoin as their legal tender, it's the financial institutions that have been set up already through the banks. There's way too much web integration for a complete transfer, or even starting to begin. So yeah, you can start talks of it, but to start saying that we're going to accept Bitcoin and we're going to also be able to issue Bitcoin, those are giant leaps, and it'll be interesting how they go about it. But the amazing
to issue Bitcoin, you have to own it. They'd have to buy a ton of it.
So he does own a ton of Bitcoin. And right. So I do see him being closer to, making some big steps, unlike El Salvador, who's saying like, oh yeah, we're going to accept it, guys, bring all your stuff. Now, he's already established within the crypto economy, and we could be seeing the first Mexican bank, crypto bank, popping up sooner than El Salvador. Who knows? I might just throw that out there. But
I definitely think if a Mexican crypto bank popped up in El Salvador, that would be odd.
That would be cool. I mean, changing their tender to crypto is the equivalent of taking the drugs from the cartel. They don't want the drugs to be legal. They still want to keep control of it. So that's why it's going to be a difficult transition for any country.
Now, with this news from Mexico, although the UK didn't affect Bitcoin, Mexico's news did, increasing Bitcoin by, I believe, I want to say 5 to 8%, bringing it past the threshold of that 35,000 that we were looking to hit the resistance. And so this could be the start of a momentum that other countries are going to build off of. If you're looking for Bitcoin to go any lower, you might have lost your chance. This might be the continuation of the bull run. It could dip down, but you got to know, big news like this compounds on itself within the crypto community. Everybody's looking to see who are the big players, how are they playing, and if more banks are talking about trying to adopt Bitcoin around the world, this is growing momentum, and so you can't sleep on Bitcoin. We've been saying this from the beginning. Take it as it is. It is high volatility, but this thing might be here to stay.
And China, you're missing out.
And back to China.
China's all about. China's very much into the blockchain. It's just that China wants their own coin, so they're very much into digital currency, but they're gonna make their own. They're not gonna allow a free floating anything. Mm-hmm. They're gonna make their own, and they're gonna.
It's gonna be run on a WeChat.
Monitor it, and then they're gonna know everything you buy, and they're gonna, there's gonna be like every data point. They're gonna know everything you do, when you do it, how you do it, how much you spend, when you spend it.
So this is the other side of what blockchain technology can provide for a country. Although it can provide decentralization, it can maximize what centralization can be accomplished through a country that wants to pretty much own all data, all transactions. We're talking about China. They're a powerhouse right now, and they have a lot of technology behind them. To say that they're not going to be jumping into the crypto market, I think that's foolish. But I was also reading that China jumping out of this current crypto market could have cost them trillions in the removal of their Bitcoin miners, and how they went about trying to regulate this crypto phenomenon.
Would you say it was too impulsive of them to jump out that abruptly?
I don't think they cared. I don't think it. Yeah.
China was never profiting really on any of that activity. People were profiting in China, so China realized like we have to shut this down because we don't want everyone to own Bitcoin. We don't want everyone to have decentralized currency that they can get and send outside of the borders. We can't regulate that. So you have to understand that the motivation. It's not impulsive to China. It's a threat to their sovereignty.
Yeah.
And that is never going to be tolerated.
It's the same way that the UK wanted to put their foot down just because, they have no regulations. They have no say on how the cryptocurrency is going to be utilized. And, I mean, for the UK, we can't say that there's the same type of communism as China. But for them to be as concerned, they're definitely not. But for them to be concerned, that means you can kind of reflect this towards the same thought pattern that China was going to have. Or was having, or already thinking into the future. They want to jump in,
Well, as I was saying before, those comments about the bank that comes from a federal reserve chairman or banker that made those comments about he brought up a lot of skepticism for a lot of the arguments for the United States creating a digital token that for their currency. That's where those arguments came from. Those arguments came from him from the United States. So every country is in big debate about this because this could be a huge disruption to the financial markets, but not necessarily in a good way, right? Because it would require massive changes to the way everything works. And as we know, when you have trillions and trillions of dollars being pinned under financial institutions and you change all that is a nightmare in and of itself. So, when you think about it, you don't just think about, the benefits and the upside. You have to think about, how hard is it going to be to actually do that, right? How hard is it actually going to be to actually implement those things? And so I think a lot of countries are skeptical both for their own digital currency, but then, of course, for the inability to change it. Because if you allow a currency in your country that can't be controlled, it's a threat to your sovereignty in any country because it's a lack of control within your country. You have effectively system of currency and an asset that you can't regulate and you can't technically see, and it's hard to tax. You can only tax the exit and entry points, but you can't really watch all that happening.
Yeah,
I can't imagine any country in the world, because even El Salvador, El Salvador is gonna. I have my theory that this is gonna turn into a giant corruption scheme, and that it's not gonna end well. But you have to have proper protocols for that. You really do, and I don't see. No offense to any South American countries, but they're not known for their security and their transparency and their lack of crime.
Yeah, so we have Paraguay. Paraguay is going to jump onto that list, and Panama is another one jumping onto this whole list of countries that are most likely in talks of cryptocurrency and how to utilize it in their economy. With China, this whole crackdown has dropped down mining by 21%. And this has in total affected the overall cost of gas fees, or what it costs to make transactions using Bitcoins. And so it's brought some highlights, and it's also brought some, openings in the market. But this is also during a time where as we thought Bitcoin was going to take a bigger hit from this, it hasn't. And it's interesting to see the momentum that's still continuing as Bitcoin is going through some of these hiccups.
Well, I was reading an article that said also most countries that restrict Bitcoin on average, generally within 18 months, either release those restrictions or reverse them. So with that being said, I think many people are just kind of, again, if you're betting on the long term of Bitcoin, all of this is just noise. And for anyone that's a diehard believer in like Bitcoin, Ethereum, Dogecoin as an asset, not the blockchain technology, the coins themselves as currency and as an asset, you're going to be in this for the long term. I've seen articles where people say financial advice is just, buy your favorite asset and hold it for everything. The Mexican billionaire for that bank, I think that was one of his exact words as well, was like, hey, if you want to make money, we're going to replace fixed income and we're going to give you an alternative investment. You pick the coin you like and you hold it forever because this is the future. And I always, when people say that, it makes me uncomfortable because I'm like, you don't know that. Nobody knows that. This is the biggest conversation in finance like in the world right now. So to say like just buy it and hold it as a financial advisor to clients as replacements for things like fixed income, you really got to have a lot of extra money on hand and just be like, yeah, I'm going to move 20% of my portfolio into Bitcoin.
It's big moves that would have to be made. Just to wrap up this whole crypto side, a lot of people have been asking about different crypto technologies and kind of what's out on the market. So I do want to start highlighting some cryptocurrencies that do catch my attention and something to look out for the future. One is going to be called Dfinity. Now, Dfinity is a blockchain singularity. They want to become the blockchain of internet. Guys, you're looking at potential Google. You're looking at potential, I want to say Yahoo. I think I said Yahoo, but this is just all about taking the internet and taking it to the next step. What is it going to look like to have your website being on a blockchain? How is it going to be able to scale up the internet? Is it going to make things faster? Is it going to make things more secure? This is one of those companies that they want to start pushing. They want to start pushing what it means to create a new type of internet. So we might be looking at Internet 2.0, Internet 3.0 coming out of companies like this. And so the reason they've made a big splash is that over the last, I want to say 48 hours, this stock has increased about 50%. Now, it has dropped from 3 months ago, dramatically. When I bought in, I was well in. I believe I saw recently I was at like $100 when I bought in. And I was just like, where it dropped, and that's
lost.
Yeah. No, I lost. It dropped all the way down to $30, and it was riding around there. Now, this is one of those investments that I was seeing, you know what, this takes off in the long run. I'm willing to take this risk and hold on to it. Now, when I saw it drop so low, there's no way in the world I was going to sell, but it did increase 50%. Getting back up there and kissing the that $40, $45 mark. And so this is a company that when I was looking at it, I thought it was at a low price.
Less than a minute.
And so with that, go ahead and check out ISP. ISP is going to be one that, who knows? If they are going to be the next internet, you see how big Google is. That was kind of convincing me enough to jump into this one. And some quick other ones are going to be EOS, Stellar Lumens, and Tron. These are ones that have been building momentum. They are hitting their ceilings, and they are... Oh, it looks like we lost them. But just for the last part, we are hitting some resistance over here. What we're doing is EOS. EOS has a beautiful analytics where this one should be hitting $10 and it dropped down to $3. When it hit this value, I was looking at this one and just, licking my chops. I rode the first bump that happened over here right before the drop. And so if you're looking at EOS as a long-term bet, this is one that you might want to look into. Another one is going to be Stellar Lumens. Stellar Lumens has been consistent throughout this market. If we're looking at this, it started to build momentum again. Everything took a dip. And here you could see that it started building up. It met some resistance at the ceiling, dropped down, but it didn't drop down below its previous floor. And these are the things that you want to note, guys. You want to see that they're keeping their momentum. And this right here, this is what I call the market breathing. You're not looking at it just drop out. What you're doing is you're seeing it continue in its momentum, and these are the big jumps that we're looking for. Look at that green candle. That is unreal, and I don't believe this is going to be stopping. We're currently we were looking at some bear indicators. I'm waiting for further indicators to show us back on this bull market, but in no way do I think we're out of this bull market. And so Stellar, if you're looking at this, you're looking at it at 23 cents. It went up to 25 cents, hit resistance, and then it started breathing again. This is all natural stuff. What you want to see over the next coming weeks is it going on the sideways market again and hopefully potentially creating a head and shoulders. Head and shoulders can be good in Bitcoin. Head and shoulders usually start indicating a bigger increase or climb. And for the last one of the day is going to be Tron. Tron is one of those old technologies. Tron's been here from the old days, and if we're looking at Tron, we're looking at Tron at still some low prices. If you have a low tolerance and you just feel like you want to throw in, $100, this thing's at 6 cents. Where Tron's been over the last year, it has built momentum, but look at this. This is a sideways market, and it has just stayed. This is very reassuring for Tron. Tron was looking at potentially, Tron has been one of those that you always hear in the background. Tron it's here to stay. Technology, I believe, is able to transfer transactions really quickly. And you know what? We'll probably cover Tron and what it has to offer in further episodes. But other than that, guys, if you enjoyed the episode, if you enjoyed what we're talking about, we're going to be here tomorrow. We're going to be going at more news, more stocks. We're going to be covering everything that you need to know to make money. If you enjoyed what you're watching and you're finding value out of this, go on our YouTube. We have all our other videos up on there. You're able to just explore and find out what it means to invest in this day and age. If you're following us, you're pretty caught up on GME and you're probably understanding what dark pools are now, blind shorts and is it blind short, naked short, and other terminology that pretty much sometimes goes over my head. But no joke, guys, the more you guys listen to this stuff, the more it just starts penetrating into what starts becoming your logic when you're trading. So guys, it was a blast. Happy that you guys joined us, and we're gonna see you guys tomorrow. You guys have a Random Rabbit Monday. You guys enjoy. You guys get all my love. Peace out.